The problem in navigating the market is difficult at the turning points because it's necessary to identify the market junctures and the important market influences. This is also the point when the majority of investing mistakes are made. Since my perspective is longer term, I am less driven by the short term volatility and the reactive nature of short term trading. Today, we're going to go over some key indicators that are based on long-term time frames to help identify market tops or bottoms. It's important to note that these are not short-term indicators and should not be used for short-term trading as they are slow to change. So let's take a look. Something that should be of little surprise to anyone and any of my followers is the relationship between interest rates and equities. We've talked about this multiple times. When interest rates rise, particularly sharply, it negatively impacts the cost of borrowing, the valuation of capital expenditures from the return on investment, and consumption. This eventually translates into slower rates of economic growth, not to mention recessions, which ultimately translates into a repricing of equity valuation or stocks. And this chart here shows that every time interest rates have reached the top of that long-term downtrend, the market has been impacted within, say, the next 12-month period. And this is a chart that I've shown you many times, including a recent video. So currently, the 10-year Treasury rate is near that trend line, and we're hovering around 3%. So watch the 10-year Treasury head up to 3%, maybe even a little above. And I think this trend line is probably somewhere around 3.1%, perhaps maybe slightly higher. And we actually may have touched that earlier this year, but my expectation is for us to return to that trend line once again in the not too distant future. But in my mind, that is a huge key indicator for a turn in a market top. And one way to see this relationship more closely is by looking at the ratio between stocks and bonds. Again, we see that the ratio, the difference between, say, the SPY, the spiders, and the TLT is at an exceedingly high level. And it has been a good indication of more important inflection points in the market. And as you can see here, this black line through here, this is the extreme overbought conditions of the S&P. And here's our current level. And you go back to the previous time when we were here in, say, mid-2006, and then at this point here, which was in early 2007, coincided with the great financial crisis. And then this time frame here in 2015, we had a downturn in the S&P. And now we're back up to this current level here, well above the extreme overbought condition as shown by the chart. And you've heard me talk about TLT. I was in TLT earlier this year, pulled out because I saw some shady trading going on. But I am looking to get back into the TLT. And the TLT essentially trades in inverse to the Treasury. So once the Treasury yield heads up, that means that the TLT is going to head down, and I'm looking for a bottom in the TLT to enter that trade once again. Another favorite of mine is the quarterly RSI, and the RSI is in the top panel of this chart that you see here. And the quarterly RSI is a very slow moving indicator, so definitely is not a short-term trading indicator. And as you can see here, I'll point some things out for you. This black line, this vertical line here, essentially was the dot-com bubble. You see here the peak of the S&P at that point there. And then moving to another point here, this line, this vertical line here, this was the great financial crisis, coincided with that point there. So the quarterly RSI back here in the dot-com bubble had peaked at that point there, and actually it took a while before the market came down. But here, as you see with the quarterly in the RSI, it just peaked above this line here. So it's just very, very small green color here, coincides with the peak in the S&P at that point there. And then here in 2000, say 14, 2015, we had a peak of the RSI, and that coincided with a downturn in the market. And then here we are currently. You can go over to this panel here to see a little bit slightly more zoomed in version, and you can see that we are at this level here. Again, this is a pretty high level, and it seems to coincide with other market tops. So again, this is the quarterly RSI. And probably my favorite indicator is what I call the monthly MACD. You might hear other people use different terms, but I don't care. So again, the monthly MACD, and essentially what the MACD means, it's an acronym, and it means the moving average convergence divergence. But that doesn't really matter. You can research that on your own if you want. But again, it's one of my favorite indicators, and it's down here in the lower portion of this chart. And essentially, you'll hear me talk about this often, is basically the, I call the line above here at this point, that's the fast line. It has a slightly faster moving average than the slow line. So the fast line, when the fast line moves through the slow line, at least on the top of the chart, that's when you have a market top. And of course, down here at the bottom, when the fast line comes back up through the slow line, that's indicating a bottom in the market. So here we go again, a top in the market, a bottom in the market, a fake out here, back up to here. We had a top in the market. Again, this was the 2015 peak, and we kind of came down here, but then back up through the fast line, up through the slow line, and we headed up in the market again. So now it looks like we're starting to top here. It's rounding off. The fast line is rounding off, so watch for that signal. And it also corresponds with the RSI and even the topping process in the price chart itself. We've talked about that before. At a top of a price chart, oftentimes you'll get this congestion up here, and then the market will break either up or down. But at this point here, being that I think we're at a peak, I would imagine things are going to break down. So we've talked about that many, many times. But again, the monthly MACD is one of my favorite indicators. And this chart here shows another indicator that I'll use, and it's the weekly stochastic. And I'll change my time frames often. I want to take a look at stocks on a quarterly, monthly, weekly, and daily basis, up and down the spectrum, because it gives you a different perspective depending upon what you're looking at. And I like to look at weekly stochastics as well. And you've seen me talk about the weekly, say, such as in the video Bridge Over Troubled Waters. It can give you some really interesting looks at the market or a stock, and it shows you that volatility, and that volatility can show you the path of kind of from stepping stone to stepping stones. So I like looking at the weekly stochastics. It's down here in the bottom part of this chart here. It's not my favorite indicator. It's probably one of the lesser indicators that I use, but again, I will look at the weekly stochastics often enough, because it just gives you another indication or a different perspective. And this last chart here is a composite of everything we've talked about, except they add in a couple of other oscillators. The Kopach curve, which is right here, say in the middle of the chart. And then the other one is the so-called ultimate oscillator, and that's in here. I don't use these very often. I think I've got enough information from the other oscillators that I don't need those. But I think the overriding message in all of this is that when you're taking a look at these signals on a longer term basis, and they're all sending the same message. Maybe not all, but majority of them are all sending the same message. And when that coincides, either high prices in the stocks or in the indexes, or low prices on the other hand, when everything's coinciding with a high price or extended low prices, then that's the time that you need to start really looking more closely at the market and these oscillators, because that will help you avoid making some very foolish mistakes. And again, we've talked about this before. Warren Buffett has his rules. Rule number one, don't lose money. And rule number two is don't forget rule number one. So, making money, if you can avoid the mistakes, the market's going to carry you on the way up for the most part, and you're going to make money. So, that's almost a given. It's when you make the mistakes and you lose money. That's the problem. So, if you can just focus on not making mistakes, everything else will take care of itself. So, one last message. If you want me to help you understand the stock market and charting, you need to subscribe. So for today, that's ChewDog Charts. Thank you.